So, welcome back and congratulations on making it through all of our discussion on mean variance optimization. You now have the main tools and the insights required to make optimal investment decisions. So at this point, I would like to take a step back and relate what we've been talking about, mean variance optimization, to an investor's typical investment decision process. So the investment decision process can be viewed as a top-down process. The first step involves the capital allocation decision, right? So namely, how you want to split your wealth between safe assets like bank deposits, money market instruments, versus risky assets, right? Equities and other types of risky assets. The second step is the asset allocation decision, right? Which involves basically deciding on the composition of the risky portfolio, right? The mix of the different risky asset classes. And finally, in the industry, the third step is usually considered as the security selection decision, right? And this refers to deciding on the individual assets within each asset class. Now, how does this relate to what we've been talking about? Well, capital allocation decision is your most important decision, right? This is the one that we talked about the capital allocation line, right? So this is your most important decision because it determines how much risk you want to have, right? How much risk exposure you would like to have, right? And the answer to that question, of course, is determined by your risk aversion, right? And also, of course, about your expectation about the risk and return trade-off that is provided to you by the risky portfolio. Now, what about the other two steps? Well, for our purposes, right, these are pretty much identical, right? We don't really worry too much about the security selection question, right? The asset allocation decision and the security selection for our purposes are one and the same, right? Basically, it involves finding the combinations of risky securities that have the minimum risk for a given level of return, right? And then identifying the one risky portfolio that maximizes the Sharpe ratio. Now, if you remember our discussion about diversification from previous lectures, this is, of course, right, what this means is the minimum risk portfolio, right, is going to be a very large, well-diversified portfolio that eliminates as much idiosyncratic risk as possible, right? So in a nutshell, this is the investment decision process, okay? So what else? Well, often investors may have additional constraints, right? So for example, we know that many institutions are restricted from taking short positions in any asset, right? Well, we can accommodate such a restriction in our problem, right? For example, a portfolio manager can easily add this constraint to the optimization problem in the form of ruling out any negative weights, right? But short positions are by no means the only such constraints. For example, some investors might require a certain minimum level of dividend yield, right? That might be a desired outcome. And we can again incorporate that into our optimization problem by including such a constraint. Another example is socially responsible investing. What is socially responsible investing? Well, it basically is an investment style that rules out investments in industries or countries that are considered to be ethically or politically undesirable by the investor, right? For example, tobacco might be undesirable to you, right? Now, the general point I'm trying to make here, however, is that while we can incorporate all of these desires, right, and constraints into the optimization problem, the price tag for the investor, of course, is that the optimal portfolio solution that will come out of these extra constraints is that it's going to offer a lower Sharpe ratio than the one that could have been obtained without the constraints, right? So more constraints, obviously an inferior solution. All right, so in this lecture, what I've tried to do is map the typical investment process to the individual steps of the mean variance optimization problem, right? The capital allocation decision and the asset allocation decision.